HR tech, work tech, and investment are transforming the future of work. Are you in the know? Welcome to the Work Tech Podcast. Join host George LaRock for expert insights on the trends, M&A activity, and strategies shaping the workplace. Brought to you by oneworktech.com and the Work Defined Podcast Network.
Hey everyone, welcome back to Work Tech. It's George LaRock, and I'm gearing up for a great conversation here today. There is one question that is part of every call, every meeting that I have with every CEO, every industry operator, investor, HR leader. Everybody wants to know, hey, how's the market? And I want to know too. And we all compare notes. We talk about, different data points, what we're seeing and hearing. And there's lots of data points that we're trying to make sense out of. And every now and then I like to ground myself. And my go-to economist is Andrew Flowers, the chief economist at Appcast. And he also runs Recruitonomics over there. It's recruitonomics.com. Andrew's been an economist at Indeed. He was a data journalist at 538, spent time at the Fed. Like I said, he's my go-to resource because he focuses on our space, looking at how everything will impact jobs and talent. Welcome, Andrew. I'm so excited to talk to you today.
Hey, George, thank you so much for having me. I'm just honored to be here, be on Work Tech, and talk to you about, as you said, the market. It's on everyone's minds.
Yeah, completely. And did I leave anything out? Anything else anyone should know about you or
Oh,
Appcast?
I live in the Boston area. I'm actually wearing a Red Sox sweater here. It's opening day
Yeah.
on Thursday, and so I have 3 kids. My wife and I, we have a dog, and so we just have. That's what you should know about me. I'm a big family man.
Yeah, cool. I now I get it because I am really a Boston guy. I'm a New England guy. Grew up there. My career was started there. I'm not there now, but that's home. That's home for me. So now I get it. So, all right. Let's dig in and just at the broadest, most open-ended question, like the one I started off with, right? Like, what do you see? What's the state of the economy and the job market at the highest level? How are we doing?
We're at an inflection point with a lot of uncertainty that's arisen in the last few weeks. But the important thing to state is that the economy at the end of 2024 was on pretty strong foundation, and even into the first quarter of this year, we're talking in March of 2025, and the first quarter of this year, unemployment is at 4.1%. We're still adding 150 to 200,000 jobs a month. Now we're lucky to see wage growth outpace inflation. Inflation's come down quite a bit from its highs in say 2022, and so as we enter the last few weeks, I would say, honestly, the economy is on strong foundation. However, there's just been a ton of uncertainty. And to some extent, that uncertainty itself is causing a lot of psychological pullback from both consumers and businesses. And that's what worries me about the next few quarters.
Yeah, yeah. That sums up. I would say the sentiment of every conversation I'm having right now. It's just, hesitancy, confusion. Even from my seat, it's like, hey, I'm busy, so I'm going to keep pressing forward. But nothing's. There's no like past as prologue here. It's I've been waiting for the other shoe to drop since COVID. So it's a really confusing time. So as you mentioned, February's job report showed 151,000 jobs added. It fell short of expectations, but and then also the unemployment rate did tick up to 4.1%, with labor participation dropping to 62.4%. What does that all mean as we look forward in the next these days, I think like the next 90 days, but let's say 3 to 6 months. What are you expecting with future job reports and impact here?
Yeah, so if the underlying strength of the economy is 150 to 200,000 jobs a month, and labor force participation, you mentioned that kind of overall number, and when we look at like even prime age workers, it's still holding up pretty high. The labor supply, the job seeker pool, in other words, the talent that powers organizations is still out there. However, let's start with the kind of elephant in the room, which is the uncertainty we talked about. I think there's a chance that job growth could weaken in the next few months, not just from, say, cuts to the federal workforce, but also just from businesses kind of pulling back on hiring. And I think actually that's a good place to think about it, is that right now the labor market is kind of frozen, where both employers are hiring less, but they're also firing less. And so there's not much dynamism or churn. And so what worries me about the future is that the hiring rate has been declining, even as we've had kind of strong job growth. And so how does that make sense? How can hiring be on the decline when we're still adding jobs? And the reason is there's just less firing, fewer layoffs, and there's also fewer quits. And so what I would love to share, if you don't mind, is just a quick chart that kind of represents this exact trend. And I talk about it as the great stay. So it means that hiring, quitting, and layoffs are all really low. And so that top line here, this orange line, is the hire rate, right? It's the number of hires made as a percentage of all employment. And you see it's really low at 3.37%. That's it's been more than a decade since it was that low. Wow. So hiring's really low, yet we're adding jobs. And how is that happening? It's because of this blue line in the middle here. That's quits, right? By workers who want a different job. If they typically voluntarily leave their job and go get a better offer elsewhere, that's typically how it works. That's also really low at 1.97%. That's well below the so-called Great Resignation. And so it's not just that there's fewer hires and that there's fewer quits. It's also that layoffs, despite what you see in the news in terms of, yes, in 2023 there were some tech layoffs, but beyond that, the broader labor market is just not seeing much churn, dynamism, turnover. And so that's what has me concerned, is with all that uncertainty, even though underlying job growth, you mentioned 150,000 or so, that could weaken just because employers pull back further on hiring.
Okay. That's a great. I love that chart and the way your analysis there. Does I know there were some changes in the part-time participation as well. Like I think It's been characterized as a significant increase. Does that have any impact here, or is that more of an impact, or is there an impact in the sort of freelance and gig space?
So you raise a really important point, which is, if I was to be a little worried, I do see signs that employers are adjusting their labor needs on the internal margin, not just on the external margin. And by external margin, I mean like firing or hiring workers, but in terms of controlling hours, right? If you think of your hourly workforce, those employers, what we see now is hours are quite low. Hours have been ticking down. That's one sign. The second sign, what you mentioned, temporary staffing services, like temporary help services, those kind of part-time workers, those the employment level for those have declined pretty significantly. And so actually job growth is outpacing hours. And what that tells me is employers typically, if they're in an environment of high uncertainty like right now, before they make any pullback on job postings or fire workers, what they'll typically do is control and manage costs through fewer hours for their part-time or hourly workforce. And we're starting to see that. Now, is that the canary in the coal mine that forebodes, future layoffs or a weakness in job growth? Maybe, but it also just may bounce back when the uncertainty cloud resolves itself. We just don't know.
Okay. So all of this is like there's a blend here that you're looking for. Some churn isn't bad. That's just the way the market works. And to your point, I've been through several ups and downs in the economy, cycles in the economy over my aged career here, but consistently, there are always layoffs, and I think there are part of what's happening here is there's a generation in the workforce right now. This is their first time really seeing, where the headlines show these massive layoffs. But back to the blend, is there a mix of, sort of growth, or how do you like to see these? What would be a good blend of, growth versus churn, et cetera?
Yeah, so I would say that we want to see dynamism. Actually, churn is not a bad thing. And from an economic perspective, it means that maybe there's better matches between workers and open jobs. It means that typically when there's higher quits, when there's more turnover, typically the labor market is more advantageous to job seekers. They get higher wage gains when the market is tight, when there's relative scarcity and employers are poaching. That's a good thing for typical rank and file workers, even if it's a bit of a headache for HR and recruiter types. That's Appcast customers. We're just being honest about like, hey, if the economy is sluggish and churn is low and you have high retention, that may be good for you and your business. For the broader economy, we typically see higher productivity, higher GDP growth when there's dynamism. And so right now, partly because of high interest rates and partly because of the uncertainty we talked about, we're kind of riding this kind of 2-year, call it a hangover from the initial boom out of COVID, right? When COVID policies and fear around the virus receded, and say 2022, 2023, we saw still really robust hiring, a kind of a bubbly market. But then we've seen some kind of adjustments and fears of a recession over the past 2 years as interest rates, really the past 3 years, as interest rates have been elevated. And I think right now we're starting to see a kind of shift towards too much caution and not enough risk taking in terms of hiring and churn.
Okay. So, that's all of that is a great macro view. I start to wonder about different sectors. And when I think about, like the Appcast world, our world in, HR technology and HR and talent acquisition, there's one category of employment that has always done really well, and that we talk about high volume or frontline work, right? High volume hiring that supports frontline work. But then in this recent, report, leisure and hospitality, which is a big driver, one of the big drivers, along with, retail and others. But leisure and hospitality lost jobs while healthcare added 52,000. And I'm wondering, which is another sort of blend there on that front line. What does that mean anything to you? How do you interpret that? What is that? What are you watching there?
Yeah, so I would say the breadth of job growth in the past 3 years has definitely begun to narrow, right? In that post-COVID boom I talked about, every industry or sector was hiring. And then when interest rates started to rise with inflation, we started to see a narrowing of the base of job growth to really focus on healthcare, as you mentioned. Also leisure and hospitality. As the economy opened up, people traveled more, went to restaurants. And frankly, that sector needed a staff back up. It was actually below its pre-COVID trend. So that was a big source of job growth over the past 2-3 years. And then the third sector, besides healthcare, leisure, hospitality, is the third one is government. We saw a big rebound in government employment in recent years.
I don't know about you, but I don't know very many people that are hopeful about the world of work. And I'd like to change that. My name's Marcus Mossberger, and I started the Hope at Work podcast, where you'll find two things. Number one, really interesting guests. And number two, innovative ideas about the future of work. Check it out.
Now, those three sectors really drove a lot of job growth, but now it's really narrowed to like one. And that's just helpful. So if I may, I'll just share another chart here. To this point about like, hey, healthcare driving job growth, take a look at this. This is showing you the most recent jobs report for February of 2025. And you see here, healthcare added 52,000 jobs. That's the blue bar here at the top. And these orange dots are just the kind of 3-month moving averages. As you go down the line, top to bottom, these are different industries, right? So financial activities added 21,000 jobs in February. Construction actually, by the way, construction has been surprisingly robust. Despite the weakness in the housing market, we've seen construction continue to add jobs from a labor market market perspective. And so they added 19,000 jobs, and so on, go down the line. And then you're spot on, George, at the bottom here, leisure and hospitality, this blue bar, it's negative, right? It's to the left. It's a negative 16,000 fewer jobs, a decline in that sector. Now, the broader trend is slightly positive, but you're right. The concentration of job growth has really become healthcare specific. And I think I just want to share one more chart here, which is before we add jobs, typically you see an uptick in job postings. And so what we've seen here, this is from Indeed data, the hiring lab where I used to work, they publish job postings metrics. And so this is the big view, right? What I just showed you was February, but this is the last 5 years. And so I've indexed the job postings on Indeed to 100 here. And you see how that whole roller coaster I mentioned is evident in the black line. That's overall job postings on Indeed, right? When the virus hits early 2025, you see a big sharp decline in job postings on Indeed, and then a sharp rise, and then this kind of like up like a rocket, down like a feather, kind of a slow decline in job postings over the past 3 years. Now, there's still 9% more jobs on Indeed in the US today than there was 5 years ago. But look at the sectors. It's a little hard to read maybe for your viewers, but I'll just say that the sectors where there's more job postings than the overall average are construction and nursing on this chart. And I think of those as standing up jobs. In not every standing up job is done well, like manufacturing has been a bit weak, but I contrast those standing up jobs, some would say blue collar jobs, but I throw healthcare in because I think of it as like a direct care providing, you're standing up, versus the kind of sitting down jobs that are below this black line. All the occupations where there's just been a collapse in job postings on Indeed, they're typically your sitting down jobs, your laptop class, your white collar jobs. So software development, marketing, banking, and so on. And so I think the broader story here is that it's one that you nailed. Really, healthcare is carrying the disproportionate burden of job growth. It's really the main source of growth, and a lot of other sectors have weakened.
Yeah. Boy, you mentioned the federal government, and while we've watched, that's that big part of the headlines, right? All the layoffs there, and it looks like they're continuing, but we haven't really seen the impact of that yet. I'm seeing, along with the headlines about the layoffs, I'm seeing some murmurs about privatization, which makes me wonder if some of those jobs may come back in different form through outsourcing. But how much will when will we feel the impact or see the impact, and what do you expect for impact there, given the activity in the Fed government right now?
Yeah, there's a lot going on in Washington. George, it's hard enough.
It's an understatement.
Yeah, it's hard enough talking politics with family and friends. To do it with kind of colleagues and people who you share the same industry interest with is even harder. But I can't avoid it. And I think we need to talk about the uncertainty. To put terms on that abstract word, I'm talking about tariffs. I'm talking about immigration policy. I'm talking about DOGE, the Department of Government Efficiency-led efforts, the DOGE-led efforts to trim the federal workforce through a variety of means. So let's just talk about those three. I think those are three worth mentioning. And so just quickly, the main topic that's dominated news cycles this month, right? It's March 25th as we're recording this. The thing that's dominated, if there's one word, anyone who's following the American political news this month, it would be what? It would be tariffs, right? Tariffs is the issue that's kind of whipsawing financial markets. And so we've had a huge change here. So here, look at this chart. This is a big picture chart, George, over about 200 years of U.S. history. We're showing you the average tariff rate. Now, what is a tariff? If you're listening, a tariff is basically a tax on foreign imports that come into the U.S. And so say it's a car coming in from Canada. We could put a tariff on that, say 10%, or the current administration has proposed maybe 25%. that they have to pay to import that car into the U.S. So here we're looking at the kind of 200-year history, and what we've seen is this huge spike in the average tariff rate because the administration has implemented an additional 20% tariff on Chinese imports. They have threatened, both implemented but then rescinded within 48 hours, those 25% tariffs I mentioned on Canada and Mexico for the non-energy goods. We've seen tariffs floated for the EU. So these are major trading partners, right? In the first Trump administration, it was all about China, China, China. But now it's all about really, frankly, our North American allies, our European allies. And what that's resulted in is what we've talked about, is uncertainty. And this metric here, you see how it's just spiking to all-time highs. What is this? This is a measure of economic policy uncertainty specific to trade. And all that this metric is doing, this is created by some economists at the Federal Reserve, it is scanning media articles, news articles for mention of things like trade war or tariffs, right? And you see, this has never been higher in the history of this series going back to 2000. And so what does uncertainty do to affect business decisions, right? So I'll think about it from a perspective of, say you're a CEO and you're trying to build a factory, right? You know, maybe have $1 billion factory you want to build. Do you build it in Canada or Mexico or Texas? Well, just the unknown of what the tariff rate will be itself is beyond the regulations, beyond the taxes, and even beyond the actual tariff, whatever that is. It's the uncertainty of, well, can't plan, to build $1 billion factory that's going to take years to develop and scale my production there. I need to know what my revenue stream is going to be. And so why don't I just put that on ice? Why don't I just put that decision of where to build it, just punt it for a few months? And so that's where you're seeing capital investment kind of dry up in the first quarter of this year. And you're seeing consumers, frankly, who aren't dumb. They know that what economists tell them, tariffs are essentially taxes on imports, and 60 to 80% of the tariffs are typically passed through to higher consumer prices. And so consumers know that prices are likely to rise. We've seen short-term inflation expectations by consumers pop in this country, but not in other countries. That tells me consumers know that their avocados and their cars and their cell phones are going to be more expensive. And that psychology of inflation expectations itself can raise prices and pull up spending, which could leave us with a hangover by mid-year. And so that's what I worry about in terms of trade policy uncertainty, cooling business investment, but also distorting consumer spending because, again, tariffs typically raise consumer prices.
Right. So that's really the biggest issue. While certainly on a individual level, on a sort of state, county, town level, I know there's a huge impact around the federal government wherever there's a workforce there. But those the rate of those layoffs, do you think that'll be absorbed, sort of like the other big announcements that we've seen the last couple of years where we started the conversation, or do you think there's so much, and it's been such a driving sector in the economy that we'll see a direct impact?
Yeah, it's a good question. This is an area of a lot of unknown, right? Because when we talk about DOGE, the Department of Government Efficiency, led by Elon Musk, and the DOGE efforts to trim the workforce, there's a variety of things, right? So number one, there was this offer of deferred resignation, the so-called, quote, fork in the road email that went out. And we saw about 75,000 federal government workers take that offer. So that's one impact that's going to materialize later in the year, not in terms of layoffs or in terms of job declines in the current data, in the current quarter. So that's one option. The other option is there was a lot of workers who were so-called probationary federal government workers, either in their position for less than a year or newly promoted. And there is attempts to let go of hundreds of thousands, roughly 200,000 of those workers. And that's in legal uncertainty, right? It's in the courts, litigated. So there's just a lot of unknowns there. But one thing I like to look at is kind of this table that I'm about to show from JP Morgan, which gives us a sense of just the scale of the federal workforce. So at a high level, the biggest number is 3 million, right? That's our total federal workforce, about 3 million. Now that includes postal workers, which are around, say, 600,000, and includes, the military and the and so when we look at the actual kind of non-military, because the second Trump administration has said that they don't want to have cuts to departments of defense, border security, and veterans affairs, or have minimal cuts there. And so what we've seen is that it's really, when you take out the postal service and the military and those agencies I mentioned, it's really around 700,000 total employees that could be cut. And so, George, to your question, this bigger point about like, hey, is DOGE going to tip the economy into recession? Or is the just general trend of federal government workforce declines, is that going to tip the economy into recession? The answer is no, not on its own. In terms of the job numbers, while it could devastate potentially the capabilities of the federal workforce in terms of who is kept or who leaves voluntarily, it won't it's just in an economy of 170 million workers, it's not going to move the needle that much, right? And another way to think about it is the total expenses for labor by the federal government is less than 4% of all federal government revenues. Or expenses rather. So it's like saving money by, if we trim the workforce, that'll save some money. And I think that there's broader efforts here. It's not just about saving money. It's about efficiency. It's about modernization. And I think it's just not enough to tip the economy into recession, or the government spending is mostly on Social Security, Medicare, Medicaid, and other programs. That's the bulk of what our government does, not the actual workforce.
Right. So to your point on the uncertainty chart, that how it feeds into that is probably from how the rest of us all feel about it as consumers, as employers. That's probably a bigger driver than the actual number is sort of how it's one of many things that may feed into, to be fair. I mean, I think it will feed into uncertainty, right? That's certainly a big headline. So, all right. Well, that was, thank you for going there with me. And that was probably the best, explanation of how it all ties together. I think everyone probably really appreciates that. One of the things I want to make sure I touch on before we run out of time is wage growth. So one of the bright spots for a while has been, when there's been sort of any bumpy patches in the jobs report, it's like, oh, but look at wage growth. And that kept growing. Growth was still there, but it eased, right, to 4%. How do you view that? What is that, what's the impact there? How should we be thinking of it?
Yeah, when it comes to wage growth, let's just go straight to the data. And you're spot on, George. I think wage growth is moderating to 3.5% to 4%. And so here's three measures of wage growth, right? The one you mentioned, the orange line here, that's average hourly earnings. That's on the higher side, around 4%. And then the other two metrics here, one includes all compensation, not just your wages, but benefits too. That dark blue line is at 3.6% year over year. And then finally, this light blue line is the advertised wages on Indeed. So again, maybe I'm biased. I'm using lots of Indeed data, but this is kind of an indicator of kind of the frontier of the labor market, like in terms of it goes up higher on the upswing and falls faster on the downswing, because it's about higher, right? It's about adding people to the workforce. And so however you slice it, all these measures, they're kind of moderating as inflation has fallen, and they're kind of in that 3.5–4% zone, which when you compare it to actual inflation, so the Federal Reserve's inflation target is around 2%. And so here I'm showing you, this is the core PCE inflation measure, which that doesn't mean anything to most people, and that's fine. If you say it, people go wild at cocktail parties. But basically, this is the Fed's inflation measure. They want it to be 2%. You see here, it's been for a while well above, but it's come down from that high point in 2021, 2022. And now it's around, it's kind of stubborn. It's sticky above that 2% target. But at, say, 2.5% or 2.75%, that's still lower than wage growth. And so finally, we've seen the labor market reverse in terms of now wages are outpacing inflation. Another reason I think my base case scenario over the next 6 months, George, to kind of wrap up, is to say, I assume the fundamentals of the economy, we're not headed into recession at the end of 2024. Like everything I just showed you is showing a pretty strong economy. If the tariff or trade war uncertainty resolves itself by the end of the second quarter, and we avoid an all-out escalation of a trade war, then I think the economy is not going to sniff a recession. We may have slightly lower growth in the first two quarters because of the factors I mentioned, of slowing business investment and less hiring, less dynamism in the labor market. That may be a short-term thing, and we'll see a pick back later in the year. But the big but here is over the next 6 months, if this trade war and escalation continues and the uncertainty around Doge really starts to affect how the government functions, it does provide everything from weather forecasting to food inspection. And if those things start to bleed into the real economy and affect firms, then we could see ourselves in a period of economic weakness. I've seen Goldman Sachs, I've seen JP Morgan, I've seen a lot of economic forecasters lower their GDP growth forecast for 2025 by about a full percentage point, from say 2.5 to 1.5. And so 1 to 1.5% is not in a recession. It's just kind of meh growth. And I think if I had to predict, I would predict meh, kind of bland 1% GDP growth this year. But that's range. We could bounce back and go back to the trend of what we expected, or we could contract and enter a recession if this uncertainty really escalates.
Yep. So to put a real fine point on it for everyone, what are the what's the 1, 2, or 3 metrics that every I have a lot of CEOs that watch this,
Yes.
a lot of investors, a lot of CHROs. Like, what are the 1, 2, 3 things you would say keep your eye on this over the next 6 months?
Yeah, great question. So I would say the first chart I showed in terms of hire rates and quit rates. That comes from the JOLTS report, the Job Openings and Labor Turnover Survey. I think that how firms actually put their money where their mouth is in terms of hire people or not, and then job seeker or workers, whether they quit their job or not, those are real concrete, money on the table decisions. And if those continue to decline and we see less churn, that's a bad sign. If they start to rebound, that's a good sign. So that's the first thing I would look at. The second thing I would look at is prediction markets. So actually, the stock market is not the real economy in terms of consumption and housing and everything else. And so it is forward looking and it is dynamic, right? It's very liquid. Traders are in the stock market every day. Yep. But something that's emerging that's also liquid and also is high frequency are prediction markets. So think of like Kalshi.com, KALSHI.com. There's lots of prediction markets for whether the U.S. will be in a recession or whether specific economic numbers will be above or below. And so these prediction markets, I think, aggregate lots of information from bettors, and that can be a useful kind of real-time signal day to day. But don't bet the farm on prediction markets, but they're a good turning point indicator. And then third and finally, what I would really recommend CEOs to follow are the monthly figures on consumer spending for kind of discretionary items. So at the end of the month, the Commerce Department releases this personal income and spending report. And so that's what I want to look at in terms of our consumers starting to pull forward some of these kind of autos, apparel, some of these kind of tariffed goods that may be more expensive in the future. Are they going to pull forward their spending, and how much so? Or if the economy starts to weaken and we start to see some job losses and higher prices, so call that stagflation, right? High inflation and higher unemployment, kind of like the late 1970s. If we start to see some stagflation indicators rise, the thing to worry about is it'll show up first in actual spending by households, where they're actually pulling back on those discretionary spending. So I would, that's my third indicator to watch.
Okay, and do you put this all together at Recruitonomics? Is that?
Yes, yeah, I should say thank you for having me. I'm the chief economist at Appcast, so check out appcast.io. We're the largest programmatic recruiting platform on the planet in terms of being the biggest buyer of Indeed, LinkedIn, ZipRecruiter, and having more than 1,000 clients to help them fulfill their hiring needs. That's appcast.io, but I run, which is powered by Appcast data, Recruitonomics. So go to recruitonomics.com. That's a free resource that me and my team of economists and data analysts, we produce commentary about European and North American economies for free, but it's oriented towards recruiters and people in the TA, talent acquisition, and HR space. So check out recruitonomics.com.
Yeah, perfect. Andrew, thank you so much. This was like a lightning round, and there's nobody better to do it. I really appreciate it. I hope you'll come back. We'll check on things in another quarter or two and see how all those metrics are doing.
Yeah, it was great to be here, George. Thanks for having me.
All right, and thanks everyone wherever you're watching or listening. Until next time.
Thanks for tuning in to the Work Tech Podcast. Visit us at oneworktech.com and find out why WorkTech is considered the most trusted source of market intelligence and strategic advice for work tech. Subscribe to the WorkTech YouTube channel for video episodes and exclusive content. And be sure to check out the entire Work Defined podcast network at wrkdefined.com for more podcasts on the world of work.